Look at your screens. Suppose you have to select one out of these two mutual fund schemes. Which one would you select? Now, as you can see, both are flexi-cap funds, where JM Flexicap fund has given 59% returns in the last 1 year. And the other fund, Parikh Flexicap, has delivered 35% returns in the same time period. Now, even if we look at 3, 5 or 10-year returns, JM has delivered higher than PPFAS Flexicap fund. So, going by these returns, which fund would you choose? Most likely JM Flexicap, given the higher returns. But what if I told you that this higher return comes with huge risk? Will you still choose JM Flexicap? Hello and welcome to our channel 5-Minute Finance by ET Money, where we talk about the basics of personal finance. In this video, we are going to compare two funds belonging to the same category but having a huge returns differential to see which one is best for you. We'll see whether we should go with a fund that has delivered higher returns, because ultimately everybody is investing with one common goal of growing their money. Or is that fund with much higher returns a bad choice for you? So let's begin. Like they say, hard times will reveal your best friends. Let's start with looking at the performance of these two funds during the hard times, meaning when the overall markets were in red. Let's compare JM's returns with Parikh Flexicap during market downturns. Take a look at the table on your screen. Out of the 12 quarters in the past 10 years, when Nifty 500 TRI has been in the red, Parikh Flexicap fund outperformed JM fund in 8 out of those 12 quarters. In the March 2020 quarter, as the market crashed post-COVID, JM Flexicap fund corrected 26%, while the fall in Parikh was limited to 21%. Similar trend was seen in other quarters as well. So looking at the fund's performance when the overall markets were in red, we can say that JM Financial carries higher risk, but we won't reach a conclusion based on only one parameter. Apart from returns, there are certain other parameters you can look at to understand the risk-return profile of funds. These parameters can help you figure out the best fund out of the two. The first measure of risk is standard deviation. Now, standard deviation of returns basically tells you how much returns deviates from their mean or average returns. So for mutual fund, it tells how much the returns of the fund deviate from the average returns. Higher standard deviation means the fund has higher volatility and vice versa. Now look at the two funds in our example. The standard deviation of Parikh Flexicap fund is 12.54%. On the other hand, standard deviation of JM Flexicap is 14.75%. This is the standard deviation of 3-year return between the period May 9, 2021 and May 9, 2024. So it clearly shows that JM Flexicap has higher standard deviation than Parikh Flexicap fund. This means the return of funds goes up and down a lot. We can say that JM Flexicap is riskier than Parikh Flexicap fund. Now the risk is higher, but has the fund rewarded its investors for the higher risk it takes? This takes us to the next parameter, Sharpe ratio. The ratio is defined as the annual return of the portfolio minus the risk-free return divided by the standard deviation of assets excess returns. Sharpe ratio basically shows how much extra return your fund is generating for the extra risk it is taking. Therefore, a higher Sharpe ratio is better. So JM Flexicap has a Sharpe ratio of 0.46, while on the other hand, Parikh Flexicap has a Sharpe ratio of 0.39. This means JM Flexicap has rewarded investors for the risk taken better than Parikh Flexicap fund. But as you can see, the difference isn't much for the risk taken. Now let's look at one more used criteria, beta, to measure which of the two funds is better for you. Now beta shows how volatile the fund is in comparison to its benchmark. Now the beta of an index or benchmark is always valued at 1. So if the beta of your mutual fund is also 1, that implies that the mutual fund returns move in line with the benchmark returns. But if the mutual fund has a beta higher than 1, it would mean that the fund is more volatile than the benchmark. And a beta lesser than 1 means the fund is less volatile than the benchmark. Now let's look at the beta of JM Flexicap and Parikh Flexicap fund. So JM Flexicap has a beta of 0.96 and Parikh Flexicap fund has a beta of 0.74. This means Parikh Flexicap is less volatile than its benchmark. So as we compare two funds on some of the most commonly used parameters, we can say that not always a fund giving higher returns will be a better choice for you. The fund needs to be fundamentally strong to sail through all the kinds of markets ups and downs. So if you look at two funds offering similar returns or even different returns for that matter, it is always better to dig deeper and analyze them on these parameters. But if you don't want to do this comparison exercise on your own, you may look at the ET Money Fund Report Card. ET Money Fund Report Card gives you a 360-degree analysis of the fund, which helps you compare between schemes and make a better investment choice. So go to the ET Money app and simply search with a fund's name and you will be directed to that fund's report card. Or if you don't have any specific fund in your mind, you may go to the category of funds on the app and look at the comparison of funds to figure out what suits you the best. And with this, we have come to the end of this video. Please let us know how you like it. Also, don't forget to like and subscribe to our channel, and we'll be back with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.